Hi friends, let us discuss Pillar 2. What is Pillar 2? What is going on by the OECD? Let us tax to your tax haven countries, Mauritius, Singapore, and British Virgin Island, Cayman Island. So if you are located at the low tax jurisdiction and your market business substance in another country, Pillar 2 want to tax you. So in this digital era, everything is digitally happen. Virtual P concept, server P is there. So what the MNC doing? They shifted their nexus to other country where the tax rate is low. So on that basis, OECD is going to adopt Pillar 2. It's a base erosion profit shifting. Step 1 is already implemented through the Finance Act, in which 15 action plan 1 targeted for challenges in respect of digital taxation. Now Pillar 2 is global anti-base erosion through the global minimum tax. Pillar 1, where it says market nexus, where is your market? They want to revise profit allocation in that respect. So now 137 out of 141 member jurisdiction of OECD G20 inclusive framework on BEPS have reached broad consensus to implement above solution. The statement containing broad overview by the OECD. So what is GLOBE? GLOBE is Global Anti-Base Erosion Taxation. The preamble says that the GLOBE rule provide for coordinated system of taxation intended to ensure large M&E group pay minimum level of tax, do not enjoy your tax profit shifted to the tax haven countries. You need to pay minimum level of tax on the income arising in each jurisdiction where they operate, where the actual is business substance. It does so by imposing a top-up tax. That is top-up over and above. Suppose if your effective tax rate is below 15%, say your ETR is 10% and threshold is 15%, top-up taxes will be levied at 5%. So it will be determined on jurisdictional basis is below the minimum rate. So this is the model. This is called GLOBE rule. So in this scenario, we basically focus on Pillar 2, since the Pillar 1 is applicable in respect of global turnover. As per your consolidated financial statement, if your global turnover exceed 20 billion euro, then GLOBE Pillar 1 is applicable. They want to reallocate it profit to the your country over and above 10% up to 25%. So what they adjust A and B. This is the basically they use the formula to seek to allocated MNC deemed residual profit to the market jurisdiction using the formulaic approach. So what is the Pillar 2? Pillar 2 basically they have chosen on the basis of CFS global turnover exceeding 750 million euro. They want to levy at least 50% tax. 15% they want to levy. So what is GLOBE rules? GLOBE rule says subject to taxation, income inclusion rule, under tax payment rule, SOR, switch over rule. So IRR, UTPR to be included in your domestic law, in your parent company. STTR, SOR to be implemented through the tax treaty, through the multilateral instrument like that. So GLOBE rule do not compel any country to adopt. They want voluntary basis. If suppose source country does not levy minimum tax, then their mother home parent country will levy. They have to choose minimum level of taxation. So what is the advantage of this taxation? It would help in avoiding double taxation and levy tax where there is a source of economic profit is situated. So how it work, let us understand. What is IRR? This is similar to CFS rule, impose additional top-up tax on the parent entity if the constituent entity is in low tax jurisdiction. Suppose you are a parent company in India and your constituent entity in Dubai. So let's Dubai wake up, pay the tax. If Dubai does not pay minimum levy of tax, then parent India has to pay through the IRR. So what is going on? Dubai, UAE already adopted 9% corporate tax, but that is different. OECD says that the domestic tax, it should be as per the model rule, then it will be treated as taxation in this. Otherwise, 9% levy of corporate tax in UAE will not fall under the pillar 2. So what is UTPR? It is a fallback rule, apply only when parent entity jurisdiction does not apply IRR. Suppose in the previous example your Indian entity also do not adopt Global rule, then it will go to further extended hands to another jurisdictional country where the economic market number is going on. It denied deduction, by way of denied deduction, make adjustment to under-tax company under the rule. So basically IRR, UTPR are interlocking rules and would be included in the domestic tax. Whereas STTR, SOR would be included in DTA. So pillar 2 take into consideration of CBCR, country by country reporting mechanism as well. So there is minimum cap also. It says if your derived revenue is less than 1 million euro, then global rule is not applicable. Even in respect of some middle lower class country, they have taken a minimum threshold for 2,50,000 euro. So pillar 2 would stand with support of these 4 pillar: IRR, UTPR, STTR and SOR. So let us understand in depth manner. So what is effective tax rate? Basically, if your effective tax rate is below 15%, then top-up tax is applicable. We need to compute top-up tax. So what is Indian government is doing? On 24th November 2021, they agreed with USA to phase out 2% levy of equalization levy. They says if we adopted pillar 1, then they will phase out pillar 2.0 equalization levy at 2% by the 31st March 2024. So what happened in past and what is planned? It says release of blueprint on pillar 1, pillar 2. So this guys, this book is on pillar 1, pillar 2. OECD has released this blueprint. So what is the Global rule says in respect of pillar 2? They also release commentary and example. The conceptual framework by G20 OECD 137 members already signed in October 21. So in December they release model rules on pillar 2. We are expecting soon they will release commentary on model rule, implementation framework, model rule for STTR. So they will adopt the multilateral instrument for implementation and addressing the coexistence of US guilty. So by the year end 22, the pillar 2 to be brought into the law. Next year in the finance bill we will see there must be some amendment in the Indian income tax also. Next year 2023, IRR to be brought into effect. In 2024, UTPR will be brought into effect. So what is the M&E? Suppose your company is doing business in particular one jurisdiction only, then it is called group company. It is not a M&E company. It is not a M&E group company. Suppose if your mother company is situated some other country and you are doing some business in all other country also, then you will be fall under the MNE group. So when this global rule is applied, they says your global turnover more than 750 in the preceding financial year, 2 out of 4 financial year, your global turnover must be 750 euro exceed, then it is scope, otherwise not in scope. So achieving minimum tax rate through the interlocking rules, they says STTR to be applied, it will be implemented through the MLI based on taxing right to source pair jurisdiction. So suppose you are making some foreign remittance to the connected person, then there must be some levy through the MLI. It will be subject to tax rule. So what is global rule? Global rule says domestic based taxation. So as I said, your subsidiary in Dubai or Singapore, they says domestic law should be taxed first. If domestic minimum tax not levy at that low tax jurisdiction, then IRR come into play. So tax right to the ultimate parent entity jurisdiction, as in my example in India. So UTPR is taxing right to the jurisdiction where the substance is situated. So this is the whole story of pillar 2. So in this step by step manner we understand what is the top up tax calculation. So step 1, aggregation of adjusted global income and adjusted cover tax. So we need to calculate jurisdictional ETR. So what is the percentage? If ETR is more than 15%, then no need to test further. No need to do anything. You are already following the global rule. If it is fall below 15%, then top up tax is applicable. If top up tax is equal to 15% minus lower jurisdictional ETR. So top up tax will apply on the excess profit. Suppose you are earning normal profit, routine profit, then you are outside from the pillar 2. So excess profit, it will be based on your substance based income. Substance will be taken into consideration of payroll cost as well as asset value. So over and above will be treated as excess profit and top up tax need to be computed. Suppose domestic minimum top up tax is levied in Dubai as well, then top up tax recovery will be reduced further. So we need to test at jurisdictional blending basis also. In my example, we have 3 subsidiaries in Dubai, Singapore. Suppose in particular one jurisdiction, then we need to compute income in club manner. 2000 minus 5000, 3000 plus 4000. So in this example, our revenue is 1000. So adjustment is possible. So global rule determine top up tax at jurisdictional level, not at global CFS level. So suppose I take another example in order to easy what is top up tax and what is the is applicable. Suppose you have 3 subsidiary or company situated in India. Indian company ultimate parent entity has 1000 revenue and tax rate is 30%. And you have one subsidiary in UAE where there is no tax. And another subsidiary, suppose Brazil, has 20% taxation where you earn loss. Another subsidiary in Bangladesh says 20%, your income is 2000. So we need to tax at this level. So what is the domestic minimum? State C, in our example Dubai, UAE, can implement qualified domestic taxation, that is top up tax, but will grant credit for withholding taxes. So first of all, we need to test what will be global impact in our final taxability. So as of now, our total pre post Globe rule profit is 2000 and tax rate is 700. So our ETR is 35%. So in this case, we need to check ETR for particular that jurisdictional. We can't say our ETR, global ETR is more than 15%. Top up tax is not applicable. We are outside from the purview of pillar 2. Since you are situated in a state C where your ETR is 0, so top up tax is applicable and you fall under the Globe rule. So what is impact? You are going to tax your 4,000 Dubai income liable to tax 15%. Since ETR is 0, 15% is top up tax, so impact is 600. So now your total tax is 1300. So guys, pick up guys, this is the time to understand the what is going on. As the Netflix policymaker says, if the pillar 2 came, then we need to hire army of accountant, because the accountant can understand pillar 2. The compliances burden, impact of new levy of tax is too high. So let us open your eyes what is going to impact through the Globe rules. So because guys, IRR is applicable in case the state C do not levy DMT, then IRR will be levied by the Indian company, ultimate parent company. If C does not trigger DMT, UPE can implement Globe rule and recover the IRR. If P, parent entity, not recover IRR, A and B, this is the A and B, will recover UTPR in the ratio of allocation key, number of employees and value of asset. B alone implement Globe rule, then B liable to tax as per the UTPR. So where the pillar 2 is not relevant, as I says, they says minimum particular jurisdiction, your revenue is less than 1 million profit, then you fall under the demonized exclusion rule. So if suppose you are maintaining portfolio and your holding is more than 10%, then you are also part of Globe rule. It says that your dividend capital gain is outside the purview of Globe rule. If your holding is less than 10%, so you are a portfolio investor and dividend and gain is subject to Globe rule. Suppose by virtue of POEM, place of effective management situated in India, then you will be regarded as resident in India, so Globe rule apply and not apply in the low tax jurisdiction. So there is a sectoral carve-out also. So if you are running some kind of ships, then you are outside from the Globe rule. So we need to understand the IFRS also, what is impact of DTA in the books, what impact of DTL in the books. So that is also part of the ETR. So let us see in our next example what is impact of DTA. So first of all, we see how follow Globe rule. Globe rule follow top to bottom approach, top to down. Suppose this entity D company is situated in low tax jurisdiction, does not levy domestic tax, then ultimate parent entity will adopt top up tax. It will adopt IRR. If suppose this company not adopt, then this company will adopt, this company not adopt, C will adopt. If suppose A adopt, B and C both are go outside from the purview of Global rule. B and C got the exemption. So same thing in case of partly owned parent entity. Suppose D company hold 100% by the B company, and B company has two different ownership, 26% and 74%. So it's suggested that IRR good to apply by the entity who hold the maximum number of percentage of this low tax jurisdiction. So it's good to adopt by the B company, because if suppose this companies adopt IRR, this company has 10,000 profit, so in this scenario only 7,400 will be recovered through the IRR. So it suggested that where the parent owned partly owned parent company owned 100% should go at that level. So this is the exception. So let us understand the concept of IRR through this example. In this example, I have Indian parent company and one of entities situated in low tax jurisdiction. I holding 51% in that entity. One entity I hold 80%, that tax rate is 25%. So in respect of this UAE entity, I need to tax 15% over and above the ETR. So in the particular example, our consolidated revenue is 5,000. My net global income is 5,000. My adjusted covered tax rate in this low tax jurisdiction is 250. So my jurisdictional IRR in respect of UAE, in my example, both entities situated in particular low tax jurisdiction. So my jurisdictional ETR is 5%. So top up tax in this respect is over and above ETR, but subject to 15%. So 10% is top up tax. So top up tax is applied on the excess profit. We need to compute substance based income exclusion. So in this scenario, our 10% of payroll cost and 8% of asset, it's come 2,000. So my 5,000 reduced by 2,000, excess profit is 3,000. So my top up tax is 300, 10% of 3,000 that need to be levy at this low tax jurisdiction. So in this the low tax jurisdiction, domestic minimum top up tax is 0. So my recoverable top up tax is 300. So now we understand how we recover top up tax 300 to the IRR. So jurisdictional top up tax in this situation is 300. So we need to proportionate allocation of 300 amongst the global income 1000 is to 4000. So our proportional jurisdictional TUT is 60 to 40. So now we further proportionate in the holding ratio. So our recoverable top up tax is 170. So TUT will be recovered through the IRR manner 170, and rest amount 130 is recovered through the UTPR. So this is the example. Now we understand what is the UTPR. Under tax payment rule, suppose the UAE is not levy DMT, although India is not adopted global rule, then what will happen? This company is need to levy UTPR. So in this example, high tax jurisdiction will be adopted global rule. So there A state, B state, number of employee is total 6,000 and net book value of asset is 2,000. So let us first segregate 600 top up tax in the ratio of this UTPR ratio. So this is UTPR top up tax. So this UTPR 600 is allocated 382A to 22B. It will be recovered either by way of disallowances of expenditure in state A or state B, or maybe some kind of transfer pricing adjustment. So this is the modus of operandi is going to your future. Your domestic, your levy should be there. There must be minimum tax need to levy. You can't enjoy your income through the Mauritius route, through the Virgin Islands, Cayman Island, or some other tax haven country. You have to pay 15% minimum levy of tax in the country where your substance is based. We need to go to the substance where you are actually located. You should not be used to the route, enjoy the treaty shopping. So BEPS is want to stop you for adopting treaty shopping. So let us understand what is the challenge in case of dividend. Suppose your Mauritius company is earning lot of revenue. Your profit is situated actually in the Mauritius. You want to give dividend to another your Indian company, and further want to give to the shareholder who is the actual owner of the company. So this in the example section 80M is play a important role. By virtue of section 80M, you not levy any tax in Indian company. Suppose 1 company is giving a dividend. You are claiming 80M deduction, you not levy to tax in the hand of I company. If suppose you are do not claiming 80M deduction, then this will be tax in the shareholder end at 30% tax, because dividend tax is liable to tax in the hand of shareholder, as well as this will be taxed in this I company also, since this 1000 will become the income of this I company, and I company also have to pay corporate tax. So what is impact of LUBI is 34% in this particular example. So let us change this example. Suppose you are operating through a country who are high tax jurisdiction and pay no UTPR, ETR, and you move out your profit from this high tax jurisdiction to a special purpose vehicle, and they then further allocated profit to this ultimate parent entity. So in this case, it says top to bottom approach is followed. Suppose this IRR is applied to in this country, India, then this adjustment can go this level only, not to this level only. In this case, 1000 dividend is actually pertain to this high tax jurisdiction company. So globally adopted by Indian company, 34% can go to this level, but not to this level. So in this case, we need to eliminate this special purpose vehicle, so that this IRR 34% levy by the UTP can directly allocate it to this country. So this will impact. We need to do group structuring. We need to thought about how the profit will move, how we will tax, how we will impact to the global rules. So let us understand STTR. As I said, this will be implemented through the MLI. MLI need to change. We need to adopt MLI, and the tax TT will levy STTR. Subject to tax rule, suppose your company is paying foreign remittance to UAE entity in respect of market and procurement service 1000. So in this respect, since UAE do not have tax and you are not paying any withholding tax in India, so 9% STTR is applicable to you. Same way, if you are taking loan route CCD through Mauritius company, you are paying 1000 interest to the Mauritius company, and Mauritius companies is levy 7.5% tax on interest as per Article 11.5 of India Mauritius Treaty. So tax in Mauritius effective is 3%, so they enjoy 1.5% foreign tax credit in India. So what they says we will levy 9% STTR, and since you already tax 7.5% in Mauritius, so we will restrict our tax is 1.5% STTR. Another example says, if you are paying interest to your UAE entity and you are making withholding tax as per section 195, since section 194 LC says that we will levy 5% withholding tax in this respect of this interest income. So you are paying less than 9%, so 4% is your STTR need to be there. So what they say is, if you are making some kind of fee for technical services or some kind of royalty, and there is interesting clause in respect of make available clause in Article 12 of India Netherlands Treaty says we will tax fee for technical services in the country where it is source, not in source, in the resident country. So Indian entity on source basis nothing is paying any tax, but the Netherlands country on the basis of residency is paying tax. So in this case STTR will not applicable, since in the it is taxed in the Mauritius country on the basis of residency, so no STTR is impacted. So let us understand whole scenario of Global rule. Suppose you are Reliance, you are Tata Steel, you are some big brand, Adani in India. Your company never sunset in any time in India, in any world. So your put call company have less than 10 million euro revenue and less than 1 million PBT, is outside from the purview of the Global rule, since it is demonized, exclusion is there, even though ETR is nil but no impact of IRR. It is says this limit below your jurisdictional revenue and profit is less than 1 million euro, we will outside from the Global. Another example in respect of Malaysia, your manufacturing presence earn no more than routine profit. You are just initial state startup, you are earning or something is loss is there, earning not a routine profit. You should have profit, but due to your initial level of a startup, you are not earning sufficient amount of profit, so you can enjoy no IRRs on excess profit. There is no excess profit in this particular case. In respect of Netherlands, as I take an example, you are paying interest from India to Netherlands and 10% withholding tax in respect of interest income. So 100 is your withholding tax. Your net interest income in respect of Netherlands is 600. So 100 divided by 600 is 15%. You already your ETR is 15%, so no IRR impact. In respect of Bangladesh, you are profitable manufacturing setup, you are enjoying accredited depreciation Same way as you are enjoying depreciation, additional depreciation in the case of section 35 AB. So whenever accumulated depreciation is there, then you need to calculate deferred tax liability. Over and above additional depreciation, your something is deferred. Same way, your current tax as well as deferred tax liability, we need to compute together. Since your ETR is more than, after considering DTL is more than 15%, no impact of IRR. In respect of Brazil, your first year loss is 5,000, second year profit is 6,000. Since you have first year loss, your deferred tax asset 15% of 5,750 is deferred tax asset of first year. That need to be reversed in the second year, since you have going to set off your brought forward losses. So 750 of deferred tax asset reversal as well as 150 tax on post adjustment. So 900 is your ETR is already 15%, so no impact of IR. So this is the case. CFS global ETR is more than 15%, does not preclude global rule to trigger. So let us see Marshall Island case, in which you are running charter of vessel operating through the international traffic. This sector is excluded outside the purview of global rule because you are already in tonnage tax system. In respect of Cayman Island, you are not paying anything, your ETR is nil, you will pick up for 15% levy of IRR. In respect of Mauritius, 3% is your net tax rate and 12% is IRR. So basically your tax haven country going to impact to the top up tax on the excess of substance based profit. Since you are Mauritius, nothing is substance, you are only operating through the TT shopping, so this minimum tax is need to be levied at that level. So in respect of France, you are earning. In respect of as well as Singapore, they follow territorial taxation basis. The tax is computed on the basis of source income. You earned from the France, you earned from the Singapore, so they tax only at that tax level. So IRR is triggered in this particular case also. So as I said, dividend, capital gain is outside from the purview of global rule. So whatever earned dividend and capital gain on the sale of shares, then it will be outside from the purview of global rule. So your holding company will not impact anything. But in respect of portfolio less than 10% holding, we need to consider dividend and capital gain also. So guys, this is the whole story of taxation, how its impact to your digital profit. In the era of digital economy, everything is taxed on the digital basis. In India presently there is a levy of equalization levy as well as substance economic based taxation is there. We need to target you. If you are situated in other country, looking at user customer base in India, then we need to tax you. So this is the system of taxation we need to we see in the foreseeable future. So hope so you understand in easy language. We read commentary as well as example given in the this blue book. OECD has given this best example, but believe me, I take so many seminars in this respect. The knowledge is still is bottom level also, because the rule is so complicated. One reading, two reading, going through example solution, you doesn't know anything unless until you read one by word in the commentary. So this is the synopsis of Globe rule pillar 2 BEPS. We will see new era of taxation in the new journey. So thank you guys. Hope so you understand the example, and anything, any query, you come to me. Thank you. Bye bye guys.